This episode is brought to you by Suzy, a cutting-edge market research software platform that empowers some of the biggest companies in the world, like Citibank and Procter & Gamble. To find out more about how Suzy can help you stay competitive, go to tearsheet.co/Suzy. Welcome to the Tearsheet podcast. I'm Tearsheet editor-in-chief Zach Miller. Today we're joined by Dan Snyder, CEO and co-founder of Lower, who's making big moves in the fintech space. Fresh off their acquisition of NeatLabs, we'll dive into Lower's evolution from consumer mortgage lender to fintech infrastructure player with their new LowerOS platform. Dan's going to share insights on building omnichannel distribution and financial services and what it takes to transform the mortgage experience through technology. Dan, welcome to the show.
Hey, thanks for having me.
Yeah, I'm excited. Maybe it's worth just backing out and give us the spiel. Who is Lower and who's it aimed at?
Yeah, so Lower, I think we're the largest venture-backed home lender that's not public yet. So
okay.
We my co-founder Mike and I started the company in 2014. We built it as I guess atypical for a fintech, where we bootstrapped it, grew profitably, reinvested the profits into expanding, and then in 2020-ish, 21, at some point you recognize, if you're gonna go raise, you're gonna have to raise money in order to do two things: fuel growth. Mm-hmm. And get on the radar of other investors and the investment banks. If you ever have any dream of trying to make what we were trying to do, is really redefine home financing in the country. Mm-hmm. We had, it's one of those things where, where do you even begin to go raise money, especially as a mortgage lender, and we were thankful enough to go and hit it out of the park. We raised with the largest Series A in Ohio history, $100 million.
Amazing.
From Excel, which is a phenomenal firm, and it's been a great experience. It was, the right investment we needed, especially at the time. We've had with the U.S. housing kind of market and a lot of volatility the last several years.
Yeah,
and so. We're keep that dream going. So right now, Lower is, we're in 50 states. We're a national lender. Mm-hmm. We do both, home purchase, through distributed lenders across the country, mm-hmm. from California to Florida. And then we have much of our online is refinancing, HELOCs, mm-hmm. cash out. How do you, everyone that has tons of equity now, we do it fast as cash, with a lot of certainty, faster than everybody, lower cost to originate. So it's been good. It's been a fun run, and we got a long way to go.
Yeah, and it sounds like with this acquisition, it's a new era for the company. But before we get into that, I'm kind of curious also, it sounds like there was a transition in your life as an entrepreneur from bootstrapping to deciding going out and tapping institutional capital. Did that impact you as a leader? Did it impact the ambiance of the company? Did something change by going externally?
I mean, if anything, it was positive. I had heard of, everyone's like, don't do that. You're going to have
lose control, right?
Lose control.
Yeah.
And to be honest with you, it couldn't be further from the truth. If anything, I got, as an entrepreneur, you get, it's a lonely at the top, they say. I mean,
sure.
You're wondering, okay, how are we doing? Do we have the right perspective? Do we have what it takes? I was looking at, not that I look at other companies often, but I saw companies in different industries that were raising a ton of money, getting the top engineering talent because they want to have stock and stock options. And we didn't have any of that structure in place. So by jumping over.
And you're in Ohio, not on the coast either,
exactly.
right?
Yeah, we're in Ohio. Exactly. We're the largest fintech lender in the country that no one's heard of. So it was a big signal, and so we kind of jumped that fence over. I think that it forced us to professionalize. Like we didn't really run board meetings as an example, and now all of a sudden it's like board meetings where your projections matter. It's like we would. I'll never forget like the first formal board meeting with our new investor, and we had projected. I don't know. Here's how we're going to do Q1, and it was a stretch goal, and we beat what I thought was we crushed the year before. And my board member was like, for a company your size, we're used to nailing our projections. So it helped professionalize. It certainly helped with connections. We recently just brought on a new president of the company. He was the former president of Redfin.
Awesome.
And it was phenomenal. And so I was introduced by, through my venture capital partner, to this gentleman, Adam. And I don't know if those types of things would happen if it was just still closely held in Columbus, Ohio.
The financial industry depends on data, but not all data is created equal. Choosing partners who can separate fleeting trends from groundbreaking innovations is more crucial than ever. If you want to unearth what forces are shaping the industry right now, download our guide at tearsheet.co/Susie. How about the move? And I'd like to hear about this acquisition. Was that prompted? I guess was that encouraged by the investors as well? Like, maybe describe the acquisition and the rationale behind it. And I'd love to jump further into that.
So in the home lending industry, we're one of the largest asset classes, largest industries in the country. Like Rocket, formerly Quicken, they have, they're either number one or number two, and I don't think they have over 8% market share, as an example. We're 25th largest lender, depending on the day, and our goal is to get to top 5. As you scale, there's a ton of cost in the loan manufacturing process, and a lot of the cost, candidly, is a lot of tech companies jumped into home lending, building feature programs throughout the process. So whether it was a point of sale, nCino, Simple Nexus, Blend, bunch of public companies, whether it was in digital pre-approval technology, digital document processing, loan operating system, etc. Because there's thousands of home lenders, there's 5 publicly traded. There's it's a lot of family businesses that are not going to invest in product engineering, etc. And it's very daunting. So we had built really good front end tech that created differentiation over top of kind of the blue chip standard product tech in our space. I was always looking for, if we're really going to go take this thing to the next level, we're going to need to have our own tech stack. The point of sale, the operating system, the pricing engine, all stuff. There's very few for sale. It's daunting to build it from scratch. Many have tried and failed. So I went on a kind of hunt to look for it and found this NeatLabs, talked to the founders. They had started in 2015. This is how challenging it is. 2015, these guys start to build the next gen mortgage company. They build all this stuff from scratch. They raise $50 million, $70 million. And they originated a bunch of loans through it, but the market changed. Just because you have the tech doesn't mean you're going to make money. And we were fortunate enough to at least have an aligned view on the world where, we believe in, mobile first, digital, speed, low cost. We have great investor base that was able to resonate with their investors. And we worked out a really good deal that, kind of allowed us to fold in their technology. We hired in their, 6 or 7 of their kind of founding engineers joined Lower. Their co-founder and CTO joined us as CTO. So it was kind of we had the spots on the team to fill. And we'll launch what we're calling LowerOS here in 6 months to we're doing, nearly, $500 billion a month in home loans. So it'll be, and, it'll really help us speed up and scale and lower our cost to originate, which is the name of the game.
So does LowerOS, is that tethered to you guys doing the underwriting? Can that be untethered? Meaning, can you sell the software and allow, I guess, a client to underwrite their own loans?
Yeah, I mean, you could. And I've been asked that.
That's where I thought this was headed.
Yeah, no, the challenge is that I think that, not to say that, never is a strong word, but, we want to be able to control our own destiny. Mm-hmm. And instead of us relying on third-party software that continues to have, arguably, they still have the same cost expense and they have less clients. I mean, the mortgage, like Rocket has their own system, mm-hmm. UWM own system, and the top three have their own systems. And where interest rates have gone up, inventory is still tight, refinance has gone away, these companies keep raising the price relative to the value they're offering. And so it's mm-hmm. hundreds and hundreds of dollars per loan file that just eats it away. And so for us, it allows us to not have that, that like linear expense. Mm-hmm. We can outrun it with scale. Would we sell it? More than likely we'll use it to attract more originators and brokers across the country to use our platform. It's all embedded. The origination, it's, the pricing, the, borrower documentation, all that stuff's all in this one stack, which is like very unique.
It sounds like it enables you to just kind of extend the front end of your business, right, into multiple channels, and really get them instead of, it touches the end user faster, I guess. Is that accurate to say?
Yeah, exactly. And it has, it allows us to, not rely on third parties' roadmaps that are trying mm-hmm. to cater to, like the main system we use, Encompass, which is a ICE product, which they're pretty much a monopoly at this point. I mean, they have small players, way smaller than us, and they've got like JP Morgan Chase that they're trying to, right. They've signed a contract to try to do all of their home loans. It's almost impossible. So how can they possibly come up with the best, customer experience?
Two different businesses, right?
Yeah. So for us, we don't. It'll be very hard for us to, really differentiate and redefine without owning it end to end. And I had no interest in building it from scratch. I thought that mm-hmm. was going to be. I whiteboarded it out with my head of product and CTO years ago, and 45 minutes in, I was like, we're not doing this. Like, this is a bridge to nowhere, to be honest with you.
Well, they talk about CEO decisioning about what not to do being very important. It sounds like that was an instrumental decision in your history.
Yeah, because it seemed like it would be easy. Like, if you've ever designed a program product and you're like, this can't be that hard. And then as soon as we got to, the seventh web of mm-hmm. complexity, and I'm like, we're going to go down this. There's going to be 1,000 webs of complexity. This is going to be hard to pull off. We just pulled the plug on it. And we're fortunate now that a lot of the hard work's been done by this NeatLabs group. I mean, they did a fantastic job. Our engineering team, when we did diligence, I was waiting for them to say, this is just junk. And they were like, this is good. This is really good. And I was like, oh, okay.
Awesome. I know we've had guest entrepreneurs on the show that talk about the mortgage as like the super product for finance. Like, it is the most complicated and hardest one to get right from from start to finish. One of the things I see in the messaging on the site, and I've heard you talk about publicly, is like this idea of expanding home ownership for younger people, particularly. Can you talk about, I guess, how your products and your feature set address that for younger customers, and why that's important to you?
Right now it's very challenging. I think that the average first-time home buyer age is 38 years old, believe it or not. Mm-hmm. That's nuts. I mean, if you looked at our population of consumers over the last 12 months, of first-time home buyers, the average income is over $200,000.
Wow.
That's just what's happened. Luckily, inventory is starting to break in most major cities, so the inventory is coming back up. Prices will fall, and if we can get some level of, we don't have to have rates go down to threes, but if we can get them into the fives, I think it'll really open up, and it'll drive that age down. So what are we doing? We think about being a one-stop shop a lot. We have, obviously, I think the home finance product, as you said, is the most complex. It's highly valuable. We've mastered that. And then can we expand it, embed it, use partners around, like we own our own title company. We have our insurance. Can we then keep that going? I think it's interesting on the real estate side with what Adam Weiner brings to the table. He was at Redfin for the last 17 years. He's passionate about it, but we had to kind of disband with several of our we'll call it embedded finance programs or products to the consumer over the last couple of years, just to focus on the core and make sure that we were expanding our core business, and driving the profits to stay above and beyond. And we've like quadrupled market share over the last several years because a lot of companies went out of business. But yeah, we think about that. Like, how do we incubate our next gen customer, next gen home buyer, before they're ready, so that when they're ready, they're using Lower.
That's an interesting distinction you make. We do a lot of talking on this podcast about servicing Gen Z customers, and particularly for traditional institutions, Gen Z hasn't proven profitable enough yet to really invest deeply for them. Yet they are the largest pop demographic in history, and if you don't get that right, you risk existential risk with that. And so it's interesting that you think of it as incubating them for sort of priming them for when they are ready to buy. How is it different than what does it take that's different, I guess, for your end customer with the Gen Z target versus maybe somebody who's older, as you said, 38 and making $200K?
Well, I think that we have really two methods. You can go online and self-serve, or you can work with one of our local top reps. It much depends on where, how you find us. So, for example, if you're buying a home, I'll just walk this through really quick. You're buying a house, you're in Chicago. The Chicago inventory is tight. You want to go find a good deal. You want to make sure you win the home, so you go and hire not just a realtor, but you're going to hire a top agent. The top agents then are going to only work with, they're not working with some random person at rocket.com. They're working with a top loan officer in Chicago. And so that's just what happens. The builders, the developers, they're going to work with the top companies that can get them done quickly and fast. And so that's a big part of our business. We have, just this week, we're opening up Louisville, Kentucky, Lexington, Kentucky, up in Rhode Island. We've got the number one team in randomly Alaska, and they're all partnered with the top agents. So that's one side, because if you're just hey, you talk to your advisors and you're like, I need a loan. Okay, Lower will do the loan. So that's whether you're a Gen Z millennial or older, how are you using your advisory status, your network is, but if you use Netflix, like we like to talk, if you can watch Netflix, you can use Lower. It's not rocket science. And we believe in the human touch. Since we started this company, we've been very adamant about, because it's cheaper for us if we're having a 15-minute chat at some point to vet everything out. Because it's very complicated. Otherwise, we end up wasting a bunch of time. So it's technology with a handshake is what we've always said, and we continue to do. It's just becoming easier and easier and easier to do more production with less workers, if that makes sense, with AI,
yeah, it does.
Name it.
What do those local offices look like? Are those Lower employees? Are those partnerships? What kind of role do relationships, I guess, play in your distribution model?
we are exclusively W-2 employees in the field. We think it brings us a ton of advantage.
Sure.
We also have a wholesale group where brokers can partner, but it's less connected. Yeah, but we believe in, and this is one of our differentiation is this we call like online offline. So all the home purchases across the country that are coming in, maybe exploring, reading at lower.com, we can pre-qualify them, pre-approve them, but they want to. It is kind of a hand-to-hand combat local transaction you're about to do. The complexities of, forget about like, broader Seattle. You're talking about like the different micro cities in Seattle. And so we will then refer in that purchase customer direct to our top agent, local loan officer, so they may not even meet in person, but they know the market together. And then it's a self-fulfilling, so that you buy a house right now at 7%, and you put a bunch of money down. Then you get into our ecosystem so that we can instantly refinance you. You can get a home equity line for cash out if you want to do improvements down the line. And it's just an amazing customer experience of offline and online. And we really are leaning into that. So we have a lot of talent joining us across the country to plug into our platform. Once rates go down a bit, and I mean, we'll have, a bunch of business coming in just only online, but we have, the purchases are still done in the local markets.
Right. What KPIs do you use personally to judge success of Lower and maybe managerial success? Like, what are your North Stars?
We have like the tip. It's how many new consumer apps are we doing a day? And how many of those apps turn into actual locked loans and then ultimately funded loans? That's on like the loan side. We talk a lot about how consumers coming in, engaging with us. I think we could do a better job. We've got a lot to do on that side of things, but how many are viewing our site, coming into the customer?
Funnel metrics.
Yeah, funnel metrics. And then we talk a lot about market share growth. I mean, we have, as a way to cut through the noise of the market, it's just like, how are we doing better than the rest? And the number one, I remember building out like forecast, I don't care what it is, as an owner, or if you're a new executive on a team, sometimes it's like drinking out of a fire hose and you're just like trying to like survive and advance. And we had those over our life cycle of just like, okay, who cares about KPIs? How about like, how many loans are we closing this month? How much revenue are we bringing in? Are we spending less than we're making? So we make money. Like,
strip it down to the most bare metrics, right?
Unit economics, obsession, right? But then at some point, you need to be able to, you're forecasting, and the rookie mistake is just forecasting like pie in the sky. And so, especially in most industries, are at least tethered to something. But we'll say, okay, like this year, all of the experts are saying that in the home financing space, there will be 2.4 trillion of home originations done in 2025. They're never right, so we'll discount that to say 2 trillion, which will be a 15% increase year over year. And then we'll say, okay, well, so like, are we better than the market? So our base
faster
case
than the market.
Our target case now is 30%. Can we double the market? Can we grow 30%? I'm not saying and so that allows you to say at a company and then all the way down to a branch level, you're not going to grow by 100%, man. Like,
right.
If you can grow by 30%, you're great. But you also on the other side, you can't blame the market that you're not growing. So we really try to take a some level of like professional methodology at this point.
Mm-hmm.
We're not, because it does matter. I mean, it's, we're, if rates drop, then, we'll exceed that, and we should exceed. But yeah, I get, I don't overly think about this stuff though, honestly.
Okay. I also feel like it's something that evolves as companies evolve. We've had founders of some of the largest fintechs on the show, and their planning now looks a lot different than it did, a few years back. And as they bring in new sort of executive managers and stuff like that, and I can imagine that moves.
Yeah, I try to get we try to keep it very real. Like we are not optimizing for valuation.
Mm-hmm.
Those are things that talk about. There's so many fintech feature, almost like these companies that are features. I see them a ton in our space that are like, what's your company? Well, we do bridge financing for homeowners. Okay, well, we do that. That's like a feature product. That ain't how do you show me a roadmap? Or we do assumable loans, or we do whatever they are, which is fine. It's just like you better have a pretty down-to-earth, grounded business model that isn't relying on fancy venture capital to fuel your business. At the end of the day, we've got, I don't know what Excel's rank is, but top 5 maybe, top 5 VC firm in the world.
Yeah.
And John Locke, shout out, he's a great guy. He's on my board, and he very, very quickly was like, let me just boil this down to you. And my team's like, are we a mortgage company? Or are we a technology company? And he was like, you're a business. Make money. You need to make money, and you need to grow, and you need to deliver value. And let's not overthink this, And I think it was good because, you've talked to people where they're trying to engineer some sort of fundraise.
Yeah.
And the easiest way to fundraise is to have a company that's growing and profitable, period.
Totally. You have way more leverage that way. Yeah. And that's evolved also through the Kool-Aid years, We're getting near the end of our conversation, and I'm curious, Dan, do you have any big, hairy, audacious goals for this upcoming year? Talked a little bit about growth here.
Oh gosh, this year. We have, last year was, we'll call we had a lot of change. We acquired, at the end of last year, a technology company. I brought in, I brought in a new head of our retail business. We brought in, there's just so much change. We acquired 4 other companies. And so this year is like an execution year for us. Okay, can we increase our business by 40 or 50%? So beat the market. Can we roll out and become one of the, a rare form in our space? If we roll out our LowerOS successfully, we'll be one of 5 in the whole United States that has their own full end-to-end tech. That's a check. And then, can we be can we start really incubating thousands and thousands, tens of thousands, hundreds of thousands of customers that are really want to buy homes, and in a content marketing type strategy that takes it to the next level, which we've brought on Adam Weiner's our president to help move us in that direction. He did it at Redfin, where they are, he had thousands and thousands and thousands of realtors, millions of customers viewing their site, creating massive content. And, I think that it starts and stops now with home financing, not just, you can't, the hardest part is affordability. And so we're the centerpiece, and that's what attracted him to working here. And, if we can do it better, faster, cheaper than anybody else, we'll really control the ball game.
Dan, great talking to you today. Dan Snyder, CEO of Lower. Thanks for joining us on the Tearsheet Podcast.
Thank you.